Welcome to the Like a Tortoise channel once again, everybody. And what a day it is. Congratulations to all of you who have been following me into Alibaba. And for those of you who've been following Like a Tortoise way before we started the channel, then you know that Alibaba was our largest portfolio position and also the one we had greater conviction in. At the time, everyone was saying, was calling China investable, and of course Alibaba. They were putting they were fleeing the country as fast as they possibly could, and I always thought this was ridiculous considering that China is the world's second largest economy. And Baba at the time, remember, I started buying shares in this company around $74 per share. Okay, so what I did, let me show you the portfolio right here because I think this shows a lot. It shows you that I have skin in the game and I like to put my money where my mouth is. Let's begin with that. But what you can see is that I started buying shares around $100 per share, and then because the fundamentals hadn't changed, but the sentiment was declining, so that created more selling pressure, and I continued to buy on the way down, and I brought my average price per share down to about $74, and the rest is history. Look, it's not to say that this is a win right yet, so that we are still below what I think to be the intrinsic value of this business, and I think I'm gonna. It's just a matter of time before I triple my investment, and I'm very confident in that scenario because, of course, all things are in line for that to happen. This has always been a great business. It's true they had some mismanagement, which led the stock price crashed 80% for a reason, okay? So yes, management got distracted with a few things, but a lot of the reasons that, in my opinion, led the stock to decline had to do with government. Remember, government decided to step in and to break their, or at least to disrupt their business model, because that's exactly what happened. Until then, Alibaba had a stronger market position, and once the government decided to step in, politics aside, but I think this is important from an investment standpoint, I think the moat got breached. Okay, so the competitive edge got breached, and that took the new management team a while to turn the company around, because it's not easy to do that when you have the government on your shoulders, when you cannot do certain things due to the new regulations that came into space, and so they really had to adapt very quickly in order to stay at the forefront of cloud AI, but also e-commerce, and of course they have been fighting competition as well very, very firmly, and I think they really are doing a very good job. Remember, this is a founder-led business, so the CEO who joined not long ago was one of the co-founders. So I love this kind of investments. It means that our interests are aligned, all right? And right here at the bottom, what happened, if you have been following Alibaba, you know that Jack Ma and the current chairman were buying shares with their own money. And I think Jack Ma invested some 100 million, and the current chairman invested, like, what was it, 150, 200 million? Don't quote me on that, but they were buying with their own money in the dump. And that, of course, led me to continue to add shares on top of the assessment that I made on the company at the time. So I'm very happy to see this because, man, I can't tell you how many people were telling me, you are crazy, Alibaba is not going to turn around. And now, here we go. So always do your own due diligence. And as long as the fundamentals don't change, don't sell out of the company just because other people don't tell you to. all right, it may very well happen that they are all wrong and you are the one who's going to be reaping the benefits. And sure enough, man, look, right now you can see, if I go here to statistics, you can see that book value per share is around $61. When I bought Alibaba at 74, book value per share was around $50. So I was buying a company that was literally priced for no future growth. How is that even possible? Ask yourself this question. It's not, I mean, I honestly believe this was ridiculous. How can a company that is involved in cloud, in AI, in e-commerce be priced as if there was not going to be any growth going forward? Well, I mean, what happened is that I decided to make it my large portfolio position, and here we are today. Okay, so what happened for the stock to be up? As you can see, 10.14%. What happens is that I summed it all up in a Word document. So Alibaba from uninvestable to an AI powerhouse. Once labeled at $60 per share, Alibaba has staged a remarkable comeback, now trading at about $180 per share. By the way, that's up 107% year to date. Okay, so I mean, this has been an incredible run so far, and I do expect it to continue. Look, it's not going to go up in a straight line. In fact, that wouldn't be sustainable. For all the technicians out there, the technical analysts out there, yes, the company may very well be overbought over the short term. But remember, if the fundamentals continue to improve, then price will always follow the evolution of those fundamentals. Behind every stock, there is a company. What else do I want to share with you? Okay, so let's go back to our Word document where I made a few notes. Aggressive AI push. The reason for the 10% surge is because Eddie Wu, current CEO, he pledged heavier AI investment beyond the already announced $53 billion plan. Okay, and he mentioned that the speed of AI industry development has far exceeded our expectations. What happens is that they are seeing so much demand that they have to up the end here, all right? AI is now positioned as a core business priority alongside e-commerce. What's more, new centers planned in Brazil, France, Netherlands, Mexico, Japan, South Korea, Malaysia, Dubai adds to its 91 current areas of operation across 29 regions. Alibaba is now one of the major AI players in the world. So, the strategy is clear. Build global infrastructure to compete with Microsoft, Amazon, and Google in cloud plus AI. And guess what? When you have a company that generates so much free cash flow, you can afford to reinvest a lot of that back into growth. And that was also part of the reason why I decided to invest in Baba. At the time, they were generating some $80 billion in free cash flow, which is ridiculous if you think about it. In fact, let's go back here to our financials. Let me show you exactly what I mean. Let's flip this to annual and go to free cash flows. You can see that free cash flows have taken a tumble, and this is expected because of all the reinvestments that the company is generating. But you can see that back in 2021, the company was generating about, let's turn this into USD. The company was generating they were generating about 26 billion dollars in free cash flow, but the net cash, that's what I meant. So the cash position was very, very high, very profitable business, generating a ton of free cash flow that can afford to make these things. All right. And so they want to be at the forefront of innovation. Certainly, they are already the major the major AI and cloud service provider in China, and they want to compete with the other global tech giants like Microsoft, Google, and so forth. Okay. What else important to know? Breakthrough in AI models. So today they also unveiled Queen 3 Max, 1 plus trillion parameters, strong in code generation and autonomous agents, outperformed rivals like DeepSeek v3.1 on benchmarks like Top 2 Bench and Queen 3 Omni multimodal immersive AI for VR, AR, smart glasses, intelligent cockpits. These guys are delivering. And I do expect all these investments to bring more profits down the line. And I think it's very exciting. Strategic partnerships, yeah. You know that recently they also announced, in fact, this was announced today, an NVIDIA partnership, joint development in physical AI, data synthesis, model training, simulation validation, and about a week or so ago, a Unicom deal was announced. So Alibaba AI Accelerator adopted by Chinese e-commerce giant, helping push chip self-sufficiency amid US-China tech sanctions. What's the main tech takeaway? Transformation from a value trap to an AI plus cloud growth story shows how quickly sentiment can flip. And I know many people, some of them very capable investors who were selling Baba in the dump as well. People got frustrated, but that's exactly what happens when you end up paying a price that is too high. And if you bought Alibaba at 250 or perhaps even at $320 per share, you are still well underwater. So again, no matter how great the company is, and everybody said the company was outstanding at $320 per share, it's not worth any price. All right, price is what you pay, value is what you get. You wait for these companies that are outstanding to come crashing down for either a specific event or a macro event, or both. And that was the case of Alibaba. And then what happens is, if you do your own due diligence, you delve deeper into these companies, and if you think so, if they have great financials backing up their turnaround strategy, then you can start accumulating shares in what can be a potential turnaround. And I think we are witnessing that right here with Alibaba. And I think for the other, of course, because Alibaba carries such a large weight in my portfolio, it makes sense that that it will drive our overall rate of return. And you can see that even yesterday, in the video that I recorded yesterday, the rate of return was about 52% or 51. Now it's almost 58%. I mean, this will happen when you have a portfolio of a few holdings, and especially when some of them already account for a big portion of your account. So let's talk in terms of valuation. Where are we? Is this company expensive? Is it still cheap? Well, based on my framework here, and look at that. So I use these three valuation methods, as you know: the margin of safety calculation, 10 cap rate on earnings, and payback time. So the 10 cap rate is only at 57, and this has a margin of safety built in. Each of them has a 50% margin of safety built in. All right, but according to this valuation method, the margin of safety price to pay for the company is $57 per share. But I wouldn't pay too much attention to that because capex is exploding, and that's what has caused the 10 cap rate to really came under pressure. You can see that operating cash flow is still 21 billion, not that different from the last time we recorded a video on Alibaba. But the capex, look what happened to capex. If I go here to cash flow and look at this, so cash flow, where is this capex? Look at this. It just exploded from March 31, 2024, and now where it came in at 32, and now is at $124 billion. Why do I say this is this for us to disregard this. The reason is I think a lot of that is going to be growth capex instead of maintenance capex, and so I think the fair. Remember, they are investing a lot into data centers and all of that, which require heavy capex infrastructure as well. But I think a lot of that is going to be growth. In other words, it's going to create future profits down the line. And so, as I think it's okay if we use depreciation and amortization as how to say it, as a proxy for capex. And if you do that, what you will see is that the owner earnings will go up. Okay, but what happens in terms of the payback time? Yeah, in other words, how long will it take us to get our money out of the business if we bought the whole company today? And ideally, we want that to be in 8 years or in 8 years or less. And if we use, of course, we shouldn't use the free cash flow. That's what I used here for just for some. I was doing some exercise, but because free cash flow got depleted, I think if we use free cash flow here, it will give you a price of $24 per share. Of course, but this is not accurate, right? Because remember, they are investing using a lot of that free cash flow to reinvest back into the business. So let's use earnings. And if you use earnings, you can see that the latest figure right here was 20. That's the net income, which I got from, where is this? Right here, the latest annual net income. That's about 20 billion, as you can see right here. And now what I'm going to do is I'm going to grow this 20 billion at 15% per year, because that's what analysts are expecting. In fact, analysts estimates earnings per share to grow at about 16%, but I'm being slightly more conservative, and I'm using 15%. And what happens is at the end of 8 years, if you sum them all up, you get the earnings cumulative. And if you divide this by the number of outstanding shares, you get a price of $135 per share. What's more, according to our margin of safety calculation, the margin of safety price we could pay is about 130. And you can see that both the margin, I want at least two models I want the margin of safety across two models to be identical. And you can see that you have 130 here, that's the price to pay, and 135 right here, which means, because we have a 50% margin of safety, this means that per these calculations, the real value of Alibaba would be twice that. Okay, so it will be around $260 per share. What about in terms of margin of safety calculation? What did I do? Well, current earnings per share is about 162, and you can see that I'm using now 15% growth. So if you expect those earnings per share to grow at 15% going forward, then you can use a default PE of 30. That's twice the growth rate, and that's why you study right here. The historical PE 10-year average is 32, so I kept it. I kept this 30. And if you grow 8.62 at 15% per year over 10 years, at the end of that 10-year period, you get the future earnings per share of $34.87 per share. And then what do you do? You simply multiply the future earnings per share by your future PE of 30, and you will get this right here. Okay, so this, assuming our assumptions are correct, in 10 years, a share of Alibaba will be worth this much, about $1,000. But remember, we now have to discount this back to the present value. And how do I do that? I always want a 15% rate of return on my investments. And so what you do very simply is, to calculate the intrinsic value, you divide this number by 4. And that gives you 261. So 261 is the value you could pay. Is the real value, the intrinsic value of Alibaba, and then you cut it in half, and that gives you 130. Okay, and that's how I got to my intrinsic value calculation. So now the question is simple. Will I sell Alibaba if it ever gets to $260 per share? That's around this level right here. Will I sell any shares until then? Until then, the answer is no. Okay, the answer is no. What happens with most Western businesses, certainly in US, is that they are trading well above their intrinsic value. So by the time Alibaba reaches its what I think to be its intrinsic value, I will have tripled my position, my investments, and by then, if the fundamentals haven't improved, that means I won't be adjusting the intrinsic value, and that means I will be out of the trade. But even if the fundamentals improve, guys, I'm gonna need to give this. I'm gonna need to assess this very carefully because China is not the US. Okay, in China you have company risk, which I don't think we really have with Alibaba, but you have country risk. All right, so I don't, and you can see if you go back to history, you can see that companies like Alibaba crash 40%, 30% multiple times, exactly because the government likes to play a strong hand in the economy, and that creates a lot of uncertainty. All right, and so this has been such an incredible performer for the portfolio, and I don't know. I'm going to have to reassess it once it gets there, but we are still a long way off. And let's sit tight. Okay, I have no reason to take profits at the moment because I still think the intrinsic value is not well, is still a long way off. Okay. So yeah, just I wanted to share this with you guys. Awesome times, and I do hope you enjoyed. And if you are in this trade like we are, just congratulations. Okay, and I'm like I said, I put my money where my mouth is. You will know if I will share with you very transparently if I decide to exit the company and why. But that certainly won't happen anytime soon. Certainly not until that intrinsic value is reached. Okay, unless the fundamentals all of a sudden deteriorate substantially, which will be a red flag. But management is doing what it should be doing in order to stay competitive, and I expect all these crazy investments to continue to bring more value going forward. Okay, and another thing, look at net income. Okay, net income. Where is this? What I wanted to share this with you as well. Let's have a look at some of the metrics on a trailing 12 months basis. Look at gross margin. All right, so gross margin is once again back up. It's been trailing upwards since the lows of in 2022. I like this a lot. And then you have operating margin again uptrending since the lows of 2022. I love this. I love this as well. And the same happens with net margin. Remember, you want to see margins improving if the turnaround is going to pan out as expected. So yeah, I hope you guys liked it, and leave a like and leave your comments. Some of you have been commenting, and I do appreciate you for that. And if you learn, I will also learn along the way. That's certainly my goal. And I hope this helps you make better informed decisions as well. So stay tuned.